Silicon Valley Bank is the most talked about bank in the world right now, thanks to its sensational demise last week as a result of a bank run on its liquidity and regulators forced to step in order to guarantee the balances of its depositors. Now, it's important to note that Silicon Valley Bank was following all regulatory requirements. However, it's how banks value their held-to-maturity assets which sparked the issue. Held-to-maturity assets aren't marked to market like other assets on the balance sheet. They're held at cost. And in the most recent financial report from Silicon Valley Bank, they reported in footnotes that they'd experienced $15 billion in unrealised losses on that held-to-maturity portfolio thanks to the fast run in interest rates. Now, this is a bank with only $12 billion in equity, which means if these held-to-maturity assets were sold, it would completely wipe out the equity on the bank, which ultimately led to a run on their assets. It seems like the regulators have stemmed the bleeding on this issue for now, but ultimately changes need to occur, and a good start would be for the US to move away from their own regulatory framework and bring themselves more in line with global regulations based on Basel III framework. To learn more, please subscribe to As Barclays Sees It by clicking the link in the description below.